At Forex.com, you can take your investment strategy beyond borders
and trade the world's leading currencies 24 hours a day, 5 days a week.
Go to Forex.com today, open a free practice account,
and experience the excitement of OTC currency trading risk-free.
Go to Forex.com and start trading currencies today.
The EU and also the Americans want to create a fund that banks pay into, a special fund, a special amount of money, so that if another big investment bank or another big financial institution gets into trouble, this money can be used as temporary financing to allow the authorities to wind it down gently, an orderly wind down rather than an abrupt, systemically problematic implosion like we saw with Lehman Brothers. So that's quite a big development, quite a good idea on balance. This idea that no bank is too big to fail, but you need to create up a new kind of resolution procedure to wind these banks down without disrupting the rest of the financial system. On the other hand, it seems that the Tories and the Liberal Democrats in Britain haven't really grasped this system. They haven't quite understood what's being proposed by both Brussels and the US, and they want to impose their own quite simplistic tax on banks, raise this money and just use it to plug the budget deficit slightly. Now that's a bad idea because it's just using the banks as milch cows at the very time that they need to rebuild their capital structure, and it's not really doing anything to make the financial system more robust and to reintroduce market discipline into the system. So I think it's quite a bad idea, and it also seems that the coalition has misunderstood actually what was being proposed in Brussels. They said that would create moral hazards. It wouldn't. Now, it's not to say that the EU should determine financial regulation. That would be also a mistake. But in this particular instance, the plan from London is less good than the plan from Brussels or Washington. What Brussels and Washington would like to do would not really do anything to stabilise the Eurozone. The Eurozone is in crisis because the countries of the Eurozone have spent far too much money and set up a single currency that doesn't work. So there's no going back from that. That's a massive problem, and unless countries like Greece, Italy, Spain, Portugal slash their public spending and change a culture in those countries to make sure that the public doesn't always want an excessively bloated government, then the euro is always going to be in trouble and it will all end in tears. The kind of tinkering with banks that Brussels or Washington or whoever else is proposing would not address that. These are different issues, but those plans would at least start to introduce some market discipline back into the financial system. Markets are extremely volatile at the moment. Everything, is all over the place. Risk aversion is going up, volatility is going up, the price of commodities has gone down, the price of gold has gone up, and so on. Now, that makes a lot of sense actually in the circumstances, which are this huge uncertainty about what's going to happen next with the sovereign crisis that has engulfed the Eurozone. These countries are in trouble. Their debt, which we all thought was safe, isn't safe. When I say we all thought, I mean when the mainstream establishment and the mainstream economists thought was safe. It all turns out this government debt isn't safe. There's a looming sovereign crisis. No one really knows what the way out is going to be from the Eurozone. No one really knows whether a country will have to leave the euro or what else could happen. And that is a major problem, and therefore it makes a lot of sense that global investors are quite worried about the state of the global economy. Let's all hope that we're not facing another Bear Stearns, but this time a sovereign Bear Stearns, which would lead to sovereign Lehman Brothers, for that would be a total disaster.
Go to Forex.com and start trading currencies today.